The jobs report for the month of December came out on Friday, and it was not good news for the people hoping that rates would come down. I'm going to explain everything next and answer questions for buyers and sellers who are thinking about transacting in 2025 in light of this news. So make sure to watch until the end. If you get some value out of this, you'll like what you hear, make sure to subscribe to the channel, hit the bell for notifications. And if you want to schedule a call with our team about how to navigate this jobs report and your real estate decisions, you can do that with the link in the comments. U.S. payrolls grew by 256,000 in the month of December. That was way more than expected. The projection was 155,000. Unemployment fell to 4.1%, 1/10 of a point below expectations. And the other jobless measure, it's a broader one, moved down to 7.5%. That's a decrease of 0.2 of a percentage point, the lowest level since June of 2024. Earnings increased by 0.3% for the month, and the 12-month gain was 3.9%, slightly below the outlook. So the jobs report came in way higher than people expected. We saw the Dow Jones came down a few hundred points. It was about 700 points when we checked on Friday. And we saw the 10-year and the 30-year, so the 10-year yield and the 30-year yield went up. So it's not out of the question that by the time this video rolls out, we could see rates in the low sevens, maybe 7.25 even, which is on the high end of a lot of expectations for 2025. And what this means, I had the chance to interview Skylar Olsen from Zillow, Zillow's chief economist. She said there may be a bumpy ride when it comes to rates in 2025, and this demonstrates exactly what she is talking about. It's very likely now at the next Fed meeting we don't see a rate cut because of this. The labor market's heating up. I mean, you're talking about a 2/3 almost jump in expectation versus number of jobs added in the month of December. I'm a big fan of jobs. I think people working is great. The Fed is looking to break the labor market. We've talked about that on the show. So what we could see are rates in the sevens for a good period of time. And historically, over the last 50 years, the average 30-year fixed rate was in the 7.7 range. So this isn't historically bad. It's just a lot higher than where rates were even a couple years ago. And I don't anticipate them going down soon. This isn't going to be like a flip of the switch here. This may be a gradual thing based on how the economy rolls into Q1. So you're thinking about making a real estate decision. You're a seller or a buyer. What does this mean? Well, for sellers, I'd be making sure that I am understanding the 3 different ways to price a home and knowing which way is going to be best for me. Strategy 1 is price low to sell above. Strategy 2 is price it right where you think the home is going to sell for. And strategy 3 is the aspirational strategy, where you price it high and are willing to come down. What we know about our local market is that homes sell on average for about 100.6% of the asking price in the suburbs. It's closer to 97% in the city of Philadelphia. So we know that homes are selling very close, if not right at the asking price. And when rates go up, affordability goes down. So there might be some buyers that could have afforded your home at like a 6.5, and now that rates are up higher and they're cresting 7, it may not be an option. So there might have to be some flexibility on pricing. Look at your feedback, see where other homes are selling for, and when you're pricing your home, it's also important to look at the competing inventory that's out there. If there's not a lot of homes for sale, you can be a more aggressive seller and price your number a little higher. If you're competing with 3, 4, 5 properties, you got to see how your home stacks up to the rest of them so that you're positioned to be one of the next homes to sell. What this also tells me is that I'd want to get my home on the market sooner and beat the competition. I hear stories of agents telling, anecdotal, hey, you want to wait till the spring or wait till after the Super Bowl, which is bad advice. What we see is that inventory balloons March, April, May. That's statistically proven and documented. The data doesn't lie. So if you have the ability to get your home on the market sooner and you can work with an agent that has a plan, knows how to prep your home, knows how to pre-market it, all of which we've got you covered with, you can take advantage of lower inventory now to beat the market, because where I'm going next is that there's a lot of demand in the marketplace right now. We're seeing that pending sales through the first week of January are up over 5.1% compared to last January in a heightened interest rate environment. So the demand is there. It's really a question of inventory and affordability. As a buyer, what I'm doing is I'm talking to mortgage lenders about programs out there besides just the 30-year fixed. Can I buy down the rate? Maybe you negotiate a concession to put that towards points to buy the rate down. Maybe you're putting more down money, or you're looking in adjacent neighborhoods where you can get more bang for your buck. You've got to look at your options when it comes to financing and housing, which is all the more reason not to just go look at homes and find something. Have a meeting with an agent beforehand to talk about strategies available, because we're seeing the demand still there. So it may be a competitive situation. That's typically the case for great properties. And what we're also seeing is that there are options out there from lenders and from a home search perspective that could get you a better monthly payment, which is what you want to focus on. I'd also be looking at taxes and insurance because they affect your monthly payment as well. And I'm getting started now, not waiting until May or June. If you're looking to settle on a home 6 months from now, this is where you want to be looking, not 6 months from now. Remember, it's going to take 30, 60, 90 days to close. So if I'm a buyer and a seller, I'm looking at moving my time frame up from a planning perspective, not from a decision-making or purchasing or transacting perspective, from a planning perspective, and get in touch with someone that knows how to navigate all this. The other thing I'd be mindful of, I'm going to have Nick put up a second chart here, and what this second chart shows is that we are seeing inventory is rising, right? So active inventory is approaching 2019 levels. And what that says is there are going to be more choices coming to the market. So with this jobs report, with rates going up, this demonstrates what I'm talking about with sellers, as well as what I'm talking about with buyers. There's more to come. Get ready now so you can be in a position to find the right home if you're a buyer. And the last chart we're going to show you here is the interest rate on outstanding mortgages. So what we're seeing is that people are moving. This number was single digits a couple years ago. I want to direct your attention to the people that have a greater than 6% interest rate is 17.2%. And this is through the third quarter of 2024. So we are seeing that people are transacting. The lock-in effect is easing a little bit. And there's also a group of folks that are still holding on to those below 3 mortgages. That's over 21%. You've got 33.9 between 3 and 4, and another 18% between 4 and 5. So the opportunities that come to the market, there may not be a plethora of them. There may not be a ton of them, even though inventory is growing. There's a lot to unpack here. You got questions? This is where it's important. You use that link in the comments to reach out to our team so we can help you navigate them.